In this video, traders, we're going to look at specific rules for the trading strategy, the outside bar strategy. Stay tuned. Hey traders, a very warm welcome to you. Okay, so let's look at this strategy. Let's outline the specific rules for the strategy, stops, limits, targets, rules, filters, everything, something to start off with that you can have a look at and maybe use as a foundation for a wider strategy, or just play around with it and see if it's got any mileage for part of your trading plan. Okay, so first of all, I would say this works best on Forex pairs, so your major US dollar pairs, maybe some of the smaller ones, but not going too minor. We're talking about the big boy stuff here. Indices like Dow, DAX, FTSE, etc. I guess you could use it on other shares and stuff, gold and what have you, but for now, let's just stick with the main things, like your main Forex pairs, your main indices, and daily chart. Now, again, you could play around with it and use it on a lower time frame. It's probably not going to work so well when you go right down the time frames, but 4 hourly, maybe it's got some mileage. Let me know how you get on if you want to have a play with it on that. Okay, so let's have a look at the rules first. So let's look at the pattern first. So outside bar, or bullish engulfing, bearish engulfing. Well, actually, it's not quite a bullish or bearish engulfing, but it's very, very similar. So a definition of an outside bar or an outside day is one where the prior day's low is taken out and the prior day's high is taken out. A bullish engulfing is slightly different, where the body of the candle actually engulfs the whole. So it's not quite that. It is actually an outside day. So the high has got to be higher than the prior day's high, the previous day's high, should I say. The low has got to be lower than the previous day's low. Let's have a look at this example right here for a long. So the criteria must be this. We must have two candles. So we've got 1, 2, let's put a number by them so we know what we're talking about. We've got to have candle 1 and candle 2 have got to exhibit classic trend day stuff. So it's got to be a lower low scenario. No kind of higher highs and odd things, just a classical lower low on day 2 after day 1. Then day 3 comes along, and this is the outside day or the outside bar. So the low has to have broken on candle 2 and the high has to have broken on candle 2. It doesn't need to engulf. I was incorrect with that. It doesn't need to engulf. I guess you could use a strategy that is a bullish or bearish engulfing, but for this intents and purposes, all we're interested in is the high and the low print. As long as they are outside that prior day, that is now triggered and we have an outside bar. If we look at a short side, just flip it on its head. We've got 2 green bars, 1, 2, and 3, and the third day is an outside bar. Outside day where we've got the high higher than day 2, the low lower than day 2. But we've got to have that higher high on day 1 and 2 before this occurs, otherwise it's negated. You can't just have this anywhere. And we've got other filters that we need to add into this. So the first filter we have is a trending market filter. So you can use, I'm going to give you a little bit of flexibility here. You can use either an ADX or something a little bit better, will probably give you a few more signals. You can use an EMA, a 10 period and 20 period. And what you're going to do with that, if I can just draw a little bit here, maybe we can't see it, but you're probably familiar with the fact that as the market starts to trend, the 10 EMA will start to drift away from the 20 EMA. So let's say there's our 10 period EMA, there's our 20 period EMA. We want this gap to be relatively large. I'm not going to give you a specific figure for that. This is kind of, you can eyeball it. You can add things that you want if you want to have something set in stone for this. But really, you just want that separation. The 10 period has got to be above the 20 period for your long, a decent way above it, or for your short. You don't want it to be kind of oscillating really tightly around each other, because that's not indicating a trending market. This has to be in a trending market. Or you can use an ADX over 30 or something like that. Anything that you want to signify a trending market, go for it. Maybe price above a moving average, maybe moving average slope, MACD, any of these kind of stuff. You probably know the score with that. Right. So once we've got a trending market, we're now looking for an outside bar after our 2 trend candles. So as we said here for our short, this one, and as we said here for our long, this one, our 2 candles, prerequisites before the outside bar, then the outside bar. Yes, we're great. So we've got a trending market, we've got our outside bar pattern. Now what? What we do is, first of all, obviously, we place our stop. In this case of our long, our stop is going to be at the low. So wait for this to close, by the way. So that's day 1, day 2, day 3. At the end of day 3, we're triggered, we're away. Right, so what do? is we're going long the next day at the open, wherever the open may be. Assuming it's going to be here, it might gap up, whatever it's going to, wherever your entry happens to be. If it's in Forex, you know your day is going to end whenever you choose your day to end, whether that's like the 10 p.m. London time, whether you're using midnight, however you're doing it. At the end of the day, if it's genuine, a couple of hours different shouldn't affect it. Well, it won't affect it because you're already taken out the high and low, and we're not looking at engulfing. So, okay, we've got the two criteria. What to do for our stop loss? Back to the stop loss, we use it as an extreme plus or minus 5 ticks or 5 pips if you're using Forex. So what do I mean by that? The low is here. We add 5 pips to that, to the downside, and that is our stop loss. So our stop loss is going to be, if I rub out that 3, and then we can see it a little bit better. Where did I put the pen and the cloth? Okay, rub out 3 here. So our stop loss is going to be at the low plus our 5 ticks here. So that's 5 ticks. I don't know if you can see it on the screen, but you get what I'm talking about. 5 ticks below that low, or 5 pips below, whatever that is. Now, your target, and obviously on the short side, it's going to be the other way around. You're going to be 5 pips above that high. There's your stop loss is going to be there. Your stop loss is going to be here. Fixed stop loss, no need to think about that any more than that. Your exit, in this kind of scenario, and you can play around with this, but in this one, we're just going to use a 1-to-1. Now, I know we've done videos, we should be doing more than this kind of risk reward, but this is a foundation to build on, to proof of concept. If you're noticing you're getting a decent hit rate for this, then you start playing around. You start looking for those runners. You start looking for those explosion moves. You start getting data. But for this, we're using the stop loss distance. So wherever our entry may be, let's say our entry's here, and that's 60 pips. Our target is going to be 60 pips to the upside. Simple as that. There's no other rules to it than that. Stop loss is fixed, target is fixed, 1-to-1. We're hoping that this has a high percentage win rate to make it a profitable trading strategy. Very, very simple to do. Easy to filter for. Like I say, you want to do it on your major Forex pairs, your indices on a daily time frame strictly, but you can try it on something a 4-hourly. Anything less than a 15, you're probably wasting your time. You want that separation between these two. Again, I think EMAs is quite a good way of doing it, or an MACD or an ADX, something like that, or just use your eyeball. You know, eyeball is fine unless you're automating something. It doesn't really matter. And there's plenty of sort of filters you can use in FinViz for this kind of stuff, distance away from moving average, all this kind of stuff to give you an approximate trend. And then you're just looking to see this kind of pattern. If you see it, you know straight away where your entry is going to be. It's going to be at the trigger straight away as soon as you see the close, or the next day at the open, whatever it may be. You know where your stop loss is going to be. You know where your target is. You're good to go. Good foundation to build a trading strategy from. All right, guys, thumbs up if you like this kind of stuff. See you next one. Oh, don't forget to subscribe if you haven't yet already. Thank you. Bye-bye.